How do you manage Greeks in diagonal spreads? If you are curious about how to effectively manage the Greeks in diagonal spreads, you are in the right place. Let's break down the key components to help you navigate this options strategy. First, let's talk about delta. Delta measures how much the price of an option changes when the underlying stock price changes. In a diagonal spread, the long option usually has a higher delta because it has a longer expiration. This means it offers more directional exposure. The short option, with a nearer expiration, has a lower delta. To manage delta, you can adjust the strike prices or roll the short option. For instance, if the spread moves too far in the money or out of the money, rolling the short leg closer to the long leg can help balance your delta exposure and reduce risk. Next up is theta, which represents time decay. This is how much value the option loses as it approaches expiration. In a diagonal spread, the short-term option benefits from positive theta, losing value faster, which is good when you are short that option. The long-term option has negative theta, losing value more slowly. To manage theta effectively, consider entering the trade when volatility is higher. This way, you can sell short-term options for more premium and benefit from time decay. Rolling the short option closer to expiration can also maximize your theta decay income. Now, let's discuss Vega. Vega measures how sensitive an option is to changes in implied volatility. The long option in a diagonal spread is more sensitive to these changes because it has a longer expiration. To manage Vega, enter the trade when implied volatility is low. This allows you to buy the long option at a lower price. When volatility is high, sell the short-term options to collect more premium. If volatility rises, the long option gains value, which can offset losses in the short option. If volatility drops, you may need to roll options or close positions to manage risk. Lastly, we have gamma. Gamma measures how quickly delta changes as the underlying price moves. Diagonal spreads generally have lower gamma risk compared to naked options since the short and long positions offset each other. However, if the underlying moves quickly, gamma can increase, causing delta to change rapidly. To manage gamma, keep an eye on your position. You may want to roll the short option or adjust strikes to avoid excessive directional risk, especially if the underlying price moves sharply. In practical terms, establish profit targets and stop-loss levels based on the Greeks and your overall risk tolerance. Use rolling strategies to adjust the short option position in time and strike to maintain a favorable Greek profile. It is wise to avoid initiating diagonal spreads during periods of extremely high volatility to prevent overpaying for the long option. Regularly monitor the spread to respond to changes in delta, theta, vega, and gamma, ensuring your position aligns with your market outlook. By actively managing these Greeks, you can improve the performance of diagonal spreads, balancing income from time decay with directional exposure and volatility sensitivity to achieve your trading goals.